One thing that is particularly interesting from my point of view is the relative outperformance of the international markets. You're starting to see Europe outperform. You're starting to see Chinese tech, really start to rally. These are areas of the market that really were overlooked and unloved for many, many years. And the U.S., particularly, U.S. tech, large cap tech has been just such a dominant theme in the equity markets. And that's really starting to crack. I think if you want to understand why, one is, the valuation premiums that, Mark's discussing. These companies over in the US are priced at much higher multiples. The other thing is, if we're going to be going down the path of a real trade war, perhaps the easier targets will be some of these multinational large cap names. They will probably impose some sort of protectionist type policies against them, which should harm them, or either they'll impose maybe certain fees or taxes to operate in these markets, or maybe even try to ban them altogether. But it's certainly, when you have so much uncertainty, it really bleeds into all sorts of asset classes. And we'll kind of talk a little bit about that with our correlations and what we're seeing as far as, digital assets, which tend to be mostly uncorrelated to equities. They're starting to show, a stronger correlation.
You're listening to CFB Talks Digital Assets, the home of informed conversation about crypto for institutions building the future of finance, presented by CF Benchmarks.
Hey everybody, thank you very much for joining us for another episode of CFB Talks Digital Assets. I'm Ken Odeluga, Head of Content, and I'm joined by my colleagues, Gabe Selby, who's Head of Research, and Mark Pilipczuk, who's our Research Analyst. Hi gentlemen.
Again, great to be here.
So it's just us three on this occasion because it is a Q1 2025 market review edition. Obviously, the QAR edition that we use our CF digital asset classification structure and the research team of Mark and Gabe dive into the market to try to determine the main drivers of the market over the quarter. So guys, just reading through this major report, which you guys can find by navigating to the research tab on our website. The headline for the main article of most of these reports is Executive Orders and Market Disorders, which seems rather apt to say the least at the moment. But why don't you guys fill in the color for us now and how that played out in the markets over the quarter?
Executive orders and market disorders, it kind of captures these two forces that we're facing here. And overall, market disorder seems to be kind of winning at the time of the recording. But basically, you've had a lot of regulatory tailwinds, and that's been met with macro headwinds and uncertainty. And so if we kind of just want to run it back from the start of the rebalance period, which starts in early December, we were seeing, a lot of bullish sentiment. Bitcoin was surging. There was a lot of institutional demand. We were reaching, new all-time highs. It first printed at 108,000 on intraday, then took it out and printed 109,000 in January. So a lot of, institutional participation on the CME. We saw Bitcoin open interest and Ether open interest making new all-time highs. We saw strong fund flows. And I think a lot of this was centered on these positive policy developments that we've kind of been hoping for. So we've seen a lot of regulatory shifts. President Trump signed an executive order to create a crypto working group. He named it Crypto Czar that would focus on digital assets along with AI. We saw a change in the SEC. They also, that included the SAB 121 repeal, and also they created their own crypto task force. But ultimately, once we started seeing a lot more economic uncertainty, mostly along the lines of tariffs and potential of a trade war, we started to see ETF outflows. So a lot of that momentum that we were, seeing us carry us into the first half of the year started to reverse. And that was not entirely, idiosyncratic to Bitcoin or to digital assets, but it was kind of seen across the board. So we really are just kind of at this point now where we're trading lower, and our CF Free Float Broad Cap Index, which is kind of like our flagship multi-token broad index, actually fell, 14.1%. And the diversified variant, which overweights smaller cap tokens, underperformed by over 800 basis points and fell 22.72%.
Yeah. And that was, I think, for the large cap indices, you wrote in this report the worst performance since September 2024. I wanted for you guys to give us a sense of the quantum of that underperformance, relative underperformance. Characterize that, because obviously that's important in terms of understanding where we are in the cycle.
We've seen it kind of ebb and flow. I mean, each quarter, we should kind of put this in perspective that over the past quarter, we had extraordinary gains. And in the September rebalance, which was from June to September, that was a down quarter. And this kind of mimics that, except for, I think we actually saw slightly broader negative breadth on this one. So we only had one token in our index that finished the rebalance period in positive territory. That was XRP. Whereas in this June to September rebalance, we actually had two. So,
yeah. And another thing to note too on that underperformance, when we look at the classification indices, we actually saw a lot more weakness than we did in any of the broad cap or anything that held some of the larger cap tokens. We had triple digit gains in the last rebalance period on some of our digital culture index, in our digital culture index, for example, but we're down 50% this period. So we've basically given back all of the last quarter's extraordinary gains there.
So is that, I was going to ask whether that's mean reversion or some sort of outright cause, but obviously it speaks to the same absolute, effect.
Yeah,
but, can you characterize it a little bit though, Mark? What are we looking at? We obviously know the market backdrop, but give us a little bit of color, I guess.
Yeah, so it's pretty typical to see these small caps under, if you think about it, they have a higher volatility than Bitcoin. So they're going to have on the downside a beta of typically more than one. So when we see Bitcoin stutter a little bit, we'll see these altcoins totally fall off a cliff. And then there was also that kind of element of regulatory optimism on the last quarter. We've started moving towards some clarity. And even at last week's crypto summit, what we saw is that clarity is really going to take some time, because they did talk and they said that there's going to need to be a bill that goes through Congress. And they're hoping they can get through it before the recess in the fall in August. But, these things can take time in Washington. And I think the market's starting to think about that on top of all the other uncertainty.
Yeah. And thinking about the distribution of gains from anticipation of that regulatory reset, is it fair to characterize that distribution profile as more favoring the large caps, or what?
Yeah,
how do you see that?
It's If you look at the way the performance kind of diverges between our free float and our diversified indices, that kind of tells you everything that you need to know. And in the June to September rebalance period, which was the last time we had kind of a sell-off over a QAR period, we actually saw a tighter spread between free floats and diversified. And in this one, it was a pretty large, which means that the outcomes were much wider as far as the more blue chip, more established digital assets were providing a lot more resilience on the downside versus the more speculative, we can just kind of point to WIF or Bonk. WIF was down 76.59%. Bonk was down almost 67%. IMX, which is also a subcategory culture related token, was down 65%. So a lot of those culture subcategory tokens were the ones that saw kind of the steepest sell-offs, whereas Bitcoin, XRP, Litecoin were actually just a lot more resilient. And if you look at the news around these things, you look at XRP, it's seeing interest for potential spot ETFs. There's been applications for that. You look at Litecoin, same thing. So I think the market's definitely trying to be more selective and try and find these more established digital tokens that have potential to tap into a wider audience, investor audience for the future.
For this part, I was going to ask you what are the highlights, but I think maybe would you characterize that as the highlight, or is there something else that we can look at and say, well, actually, what would you say?
Well, I think that's a good start. Another thing that I'd kind of point to is just, look, we're in kind of a correction territory, and we can kind of talk about more of that later. And you can maybe probe us a little bit on how we define corrections and bear markets in digital assets, because I think it's something that's a bit more ambiguous. And so, but I think the other thing is just to kind of understand that, when you're seeing such broad-based risk sentiment that's tilting towards safety, you're going to see correlations change. And so we can point to that, and we in our correlation heat map that we do every quarter that asks the question, what's driving crypto? And so it was interesting to see that, we're starting to see digital assets start to move in a more positive way with things like the S&P 500 and the NASDAQ, which, in the previous quarter, despite the run up in both the digital assets and the NASDAQ were actually uncorrelated. They were
Very
basically
weak
zero. Now they're trying to
correlations,
trend up.
weren't they? Yeah, yeah.
So
if I can just quantify that quickly for you, 0.25 and 0.17, that is the correlation between the free float broad cap and S&P 500 and NASDAQ, was the correlation in this quarter compared to 0.1 and 0.03 in the prior quarter. That's a range, obviously. So yeah, clear vector, and also, very much a correlation that emerged in the quarter. So that you got to sort of predicate it on the idea that it was a reaction, right?
Yeah, exactly right. So it's just gonna, I think, continue to evolve, but it just shows you that in down markets, it's tough to find protection. But one thing that we can point to is that we're seeing, new products that can offer that. And we launched the BVX, which is a Bitcoin volatility index. That's something that has shown to have, negative intraday correlations with Bitcoin when it has steep sell-offs. Also, the spot ETFs now have put options that, you can trade just like any other option. So you have protected puts, but the demand for hedging in these environments I anticipate continue to go up. I mean, we just saw open interest on, I think, the SPY put options reached a new all-time high. So as we've seen in history, time and time again, downside markets tend to bring correlations tighter together. And certainly that's the case here with digital assets.
Can I bring in a little bit another sort of level for this correlation piece to quote from that section? Additionally, correlations with fixed income assets have shown mixed results, with the strongest positive correlation observed the 20-year Treasury bonds at 0.22. Obviously, that can bring us into something more of a macro discussion, maybe policy discussion. But what is that telling you?
So over the most recent rebalancing period, it's important to think about like our start and end points when we kind of look at that increasing correlation. We saw a pretty good move up in yields, move up in yields between September and December, really, between when the Fed took that pause. Following that, and really in the last month or so, we've seen long dated bond yields move down significantly. The 10-year is now well under 4, is close to 4.25 from close to 4.8 at one point. So I think that signal in the short term that the bond market's kind of sending is that there is a growth scare. So the bond market is looking for lower rates. And when you have that growth scare, you have rates come down, but you'll also see risk assets come down. So you'll see, if you look at the correlation map, you'll see the correlation actually increased with the Russell 2000 index. So in times like this, when there's a growth scare, you'll often see those small cap, less profitable companies, kind of those longer duration assets sell off. And so far, digital assets have behaved more like an unprofitable tech company, one of those longer duration assets that's more sensitive to risk in the economy. And it's shown through here.
Yeah. And the other context for the interest rate picture, or the rates market picture, is the fact that you've still got a 4% in the sort of like benchmark yield, the 10-year, and we are down from something like 4.79, I think it was, at the highs, or rather going back to what you say, September, or was it a little bit later?
It was a little bit. Yeah, we hit the highs in the January timeframe.
Okay, and then where we are now, did you say 4.22 to 4.25?
Yeah, we're around a 4.25 last time.
So we're clearly still about 4%, but it's been a more than a perceptible, a palpable decrease in the benchmark rate. So that's a very nuanced picture, considering where we are in terms of the the risk assets, and certainly when you look at the markets today or any day this week over the last couple of weeks, that's a more nuanced picture than you perhaps would suspect would be natural or normal. Do you not think?
Yeah, I think you got to take it into context with kind of like where the benchmark rate is on the front end with the Fed. It's basically like an unwinding of the steepening curve that you saw post the Trump election rally, which really starting to price in super pro growth type policies, deregulation, tax cuts, and perhaps not entirely factoring the risk of tariffs or all-out trade war, which is what we're trying to, I think, adjust to right now in that potential. And with that, you see the yield curve flattening or even inverting again. And that is going to work its way through, the real economy eventually. I think, as far as what we can anticipate with tariffs is that you'll see growth lower. You'll see potentially inflation higher, but growth will probably come first. I think the tariffs and the price impacts will probably have a little bit of a lagging effect, but we're already starting to kind of see that in the real economy. And so risk assets overall are just not liking this environment or the uncertainty around it. And that's causing, treasuries to catch a bid. It's causing yields to compress more, but we still are faced with, restrictive monetary regime. And that's where the Fed's sitting at. And they don't seem to be, echoing any sort of, willingness to kind of change course. But I think Mark can kind of give you a quick rundown. Maybe it would be helpful on where the markets are kind of pricing in rate cuts, because this is kind of maybe a little bit more forward looking for a review, but just to kind of give the audience a perspective.
Yeah. So just to get an idea of where we came from, we came off the December Fed meeting, we went on pause, and we saw them in the dot plots put 2 cuts in for the year. And until about 2 weeks ago, that was pretty much what was priced into Fed funds futures. We were pricing in the first cut in maybe July, and then we had 2 cuts priced in by December. So we had kind of a July and a December cut is what was priced in. Looking at that today, we have a first cut priced in June. We're at 1.8 cuts for July, so maybe 2 cuts by July, and then at close to 3.5 cuts for the year. So now the market's leaning towards maybe 4 cuts. Yeah. And if you think about it, that kind of makes sense. If we are going to go into a time with slower growth, which might already happen regardless of where the policy shakes out. Because if you look at some of the surveys and what people are saying, it's very hard if you're a business owner to plan or a company to plan CapEx around the potential for tariffs if you don't know where that's going to land. So what we're doing is we're essentially sitting on pause. We're not starting any CapEx. We're maybe not hiring. We basically kind of frozen the economy until we get some clarity here. And that's going to have effects, even if you get unfrozen relatively soon here. That's already, some of the damage is already done.
Sure.
This kind of brings me to like this interesting discussion point that we highlighted in the QARs is, what comes next? And so we basically have 2 different forces here. We have, the uncertainty that's being primarily spewed out by the executive branch, the White House and the Trump administration. And then we have kind of this monetary uncertainty as far as, are we going to get to see a Fed put? Are we going to get to see rate cuts materialize? Is the money printer going to come back on? And so one thing that was kind of interesting was just this relationship that we highlighted in our Ultra Cap 5 index QAR, which broke down the influences of something like the M2 money supply and Bitcoin's price. So the reason why we kind of wanted to highlight it in this section is because in that index or Ultra Cap 5, it's over 70% of it is actually Bitcoin. So this chart's been kind of making its way around X, and I've seen a lot of other crypto and influential people, analysts, researchers kind of highlight this relationship, but it kind of just shows this correlation between the global M2 and Bitcoin's price, but you have to put a little bit of a lead on it. So in this case, I think we did a 3-month lead on M2, overlaid it with the price chart of Bitcoin. And sure enough, we started to see M2 contract 3 months ago. Then it kind of put us in this trough, this lower zone right now, and Bitcoin's price eventually followed suit. I'm not at all surprised by this, but if you want to look at what's around the corner, we're already starting to see M2 kind of reverse and go back up. And if we're talking about, a potential Fed put that might be coming because of the uncertainty that's coming from the executive branch and the White House, that could drive even more, money printing, more monetary debasement. And that's something that's kind of been a catalyst for Bitcoin all along, is kind of this thesis of hedging against monetary debasement, sound money principles. And so we really didn't show kind of like the next phase of this in the report, but we'll be putting out an outlook, this month, and that will have kind of more of a forward-looking implication of what we're seeing and what we should potentially expect with money supply and further debasement in the dollar.
Yeah, as a sidebar for those comments from our head of research, the page that you need to look at to follow along is page 8, and the headline, the title of the chart is Global Liquidity Trends Halt Bitcoin Rally. And yeah, it's another dimension of sort of like assessment of the strength of Bitcoin within the macro space relative to money supply. So guys, is there anything else we need to mention within this section before I jump onto the next part?
Yeah, just another thing,
sure.
on an observation on global money supply. Just another thing to watch out for is if you look at the dollar index. So the dollar has moved down from 110 to about 103 in the last few weeks. So when you have a weaker dollar, this doesn't just impact U.S. monetary policy. It also impacts foreign nations. You're now able to, if the dollar's weaker, you have more room to cut interest rates or to maybe do stimulus without, essentially devaluing your currency and disrupting your balance of trade any further. So when we have a lower dollar, and considering that the tariffs don't just impact the US, they'll impact other countries. I think that does give other countries room to further print money or to debase their currency without losing all that much. And that could really push global M2 higher in the coming months. So that's just something to watch for.
Yeah. So I wanted to now move on to a section where we pretty much cherry pick some parts that particularly stand out to us. But before we do that, though, I do want to get back to Gabe's point about flight to quality and potentially interpreting that trend as XRP being a major recipient. So I want to ask you guys, because, outside looking in, I'm a typically risk-averse portfolio manager. I look at XRP, and in fact, maybe I'm a bit more, knowledgeable and informed than I would have been like 6 months ago, because I've read maybe our recent newsletter, and I'm seeing like the SEC's like dropping court cases left, right, and center. But XRP, no, XRP still got that sort of like appeal open, maybe in name only, but it's still open. This thing is in a sort of legal battle with the SEC, and it's got all sorts of like baggage. How can you sort of argue that it's quality for someone with that mindset? I mean, I think it does, but what would you say?
I would say XRP's quality factor probably mostly is centered on its fact of it being one of the largest market cap tokens out there that's been around for a long time as well. So it's big and it's been around for a while. That means it's established. And right now the market seems to be picking out established names that potentially have room for increased adoption. And, over the most recent rebalance period, we also saw the announcement of CME Solana futures. So that's, another, I think, a feather to the cap of the Solana ecosystem and that digital asset. And so these are kind of like the things that people are looking out for, is this going to unlock potential for a spot ETF on Solana? And you've seen a lot of other asset managers file for XRP ETFs, as well as, Canary filed for their Litecoin ETF. And those are the names that held up from more of like a relatively resilient standpoint compared to, we could just call them more speculative grade digital assets that, did not perform very well at all.
Let's try and bring things a little bit up to date then, chaps. We've clearly seen quite the correction across asset classes and including crypto and within crypto as well. So tell me what the standouts are, what we should be paying particular attention to following the correction pattern that we've been seeing over the last few days, maybe up to about a week.
Well, I thought it would be a good opportunity to kind of help the audience understand where we're at in this market cycle. One, to kind of help ease some fears, maybe put it in perspective, but also to take this opportunity to kind of define, what is a correction for digital assets? What's a bear market for digital assets? And so one approach that, we thought would make sense is to do kind of like a volatility adjustment for these thresholds that, if we were to look at equity markets, for example, a 10% decline is kind of universally known as a correction, and a 20% decline is universally known as a bear market. But crypto, which has about, a 3x multiplier on something like the NASDAQ 100, would actually be in corrections, almost all the time. So we thought it'd be a good general rule just to kind of adjust these definitive terms higher, which makes sense, right? So if we were to just take the 3 times golden rule here, times it by the 10% decline, we would see that a 30% threshold is what we would define as a correction. And that's exactly where we're at right now. So, a bear market's actually at 60%.
For large
Yep.
caps,
For large
Bitcoin.
caps.
Yeah.
So I think it's important to highlight that we're using the diversified index, which actually gives you a little bit more exposure to the smaller cap names. It gives you a little bit more volatility to kind of give you a better picture. But, I think it's just important to highlight this because, we've seen a correction in bull markets. I'm sorry, we've seen corrections in bull markets before. It happened last year. It happened throughout the summer months, post the ETF rally, which then led to some sideways chop and ultimately, a 30 plus correction then. And then we got a V-shaped recovery out of it. So I think for us, we're really kind of in this wait and see mode. We're 30+% down. We're not in a bear market yet by our definition, but I think depending on more idiosyncratic factors potentially, we're going to be looking at macro liquidity trends. I think we talked about how that could be reversing. And, if we get some sort of clarity with this trade war stuff, that kind of helps boost investor risk appetite overall. I think that's going to set us up for another kind of V-shaped recovery versus kind of a more prolonged downturn, which is what we're trying to avoid. But this is kind of like where we're at in the cycle.
Yeah, and those are really some great definitions that you kind of gave us for what is a bear market and what is a correction. Those kind of performance thresholds to think about. And then another thing for you to consider as a portfolio manager in the space is the return dispersion within the asset class. So I mentioned earlier how some of our culture tokens had betas greater than 1 to Bitcoin. So we're talking about how a correction is greater than a 30% move. If you take a token like, WIF, you're down 80%, and you have a downside beta of greater than 2 to these things. So when you look at your portfolio and you look at where you are, large cap versus small cap, it's just important to think about the type of dispersion and what those higher betas mean, given the size of the drawdowns and upswings we can see.
The sense that I get to an extent is that where we are now, well, obviously, the beginning of the second quarter, it could obviously go any number of ways from here, but we do have a little bit of a message from the foregoing quarter. And one sense, going back to quality, if you like, the flight to quality, I'm suspecting that in terms of quality being exposed or quality sort of like surfacing or making itself a better known, maybe that sort of pattern is not fully realized yet or fully, complete. Would there be any other particular protocols or in particular themes that might actually play out in a positive way in the coming months, I should say?
Yeah. One thing that I kind of wanted to highlight here is I wanted to use Aave as an example of it'll give you a little bit of an insight as to where we're going in the market, where we are, and then it also shows what a kind of quality and stable growth looks like in a protocol.
Yeah, good.
So if you go into the DeFi index report here, and you'll pull up the chart on page 8, we have here the monthly user interactions with the Aave protocol on Ethereum. And we also have a ratio, and that's the ratio of borrow transactions to loan repayment transactions on the protocol. So the first thing that we'll note is over the last 12 months, we've seen just a steady, slow monthly increase in users that's actually amounted to about a 200% annual growth in users. So we have, despite all of the chop and noise that's happened over the last year, steady growth. That is that's an indicator of quality right there.
Absolutely.
And then another thing, that borrow to repayment transaction ratio, I almost look at that as, how healthy is the underlying loans on the protocol as a lending platform? Like, are people taking more leverage or are they decreasing leverage month over month? So we've seen that borrow to repayment transactions. It really peaked out in November when we got that initial move up. We saw demand for leverage increase, but really since January, we've seen that come lower and lower to the point where it's gotten below 2 borrows for every repayment. So we actually saw a little bit of a deleveraging ahead of the sell-off and into the sell-off. And this is when you're evaluating the quality of a protocol like Aave, when you see volatility come up, you want to see broad deleveraging so you don't have that risk of the protocol or the pool blowing up or something.
Perfect. And as we wrap up, maybe one of you or maybe both of you, if you're so inclined, give us some sort of thumbnail characterization of the quarter, maybe a little bit of a hint as to what you sort of like expect in the next incremental step. So that's obviously very short term. Maybe Gabe, you can go first.
Well, I think if you believe that this is a scare that's not going to ultimately lead to a fundamental, bear market or crypto winter, right now you can go through the report and you can see some names that are pretty heavily discounted. So if you were left scratching your head thinking, why did I miss the run up last time? After the election, there's opportunities now to find things on fire sale right now. So Mark's been great at breaking down kind of the beta relationship, sensitivity to the market, and how that translates to, more price fluctuations. So just like that gearing worked on the way down, repositioning for, a recovery and getting geared up for higher prices is something to consider, looking at these names. Now, that being said, in the macro side, it does feel like we're still kind of early as far as the uncertainty is going. And we certainly are expecting to kind of see more and more announcements on the trade front, more tensions building between nations. And we know how that's every time that's happened, it's caused, sell-off basically in the markets. So without caution investors to position well and not over leverage, or maybe don't leverage at all. If you don't use leverage, you will be sleeping through this probably pretty soundly without the worry of getting a notification that you're being liquidated. And you can kind of size your bets appropriately. But there, in chaos, there rests opportunity. It's time to kind of lock in and see where these fundamental catalysts are. Maybe some protocols will continue to kind of build, and certainly we expect that. And that's maybe where you should focus your attention on.
Yeah, Mark, I think you probably feel like you've already answered my question of, the characterization of the quarter and potential, small look ahead on the near horizon. But, if I could get you to summarize.
Yeah, just to recap everything here. What I've noticed going through our classification indices in particular is there's this real divergence in performance between protocols that are seeing continued growth and adoption and things that don't have any real users or maybe less of that fundamental value in this type of environment. So this presents a good opportunity to take a step back, to look at maybe what's holding up well, and then to look at the underlying network fundamentals to get a feel for what quality looks like and how that manifests in the digital asset space going forward.
Absolutely. Perfect, guys. And thank you very much indeed for that wonderfully insightful discussion. Perfect. So guys, if you've enjoyed that, you know what to do. There is actually a report that this talk was based on. You need to navigate to cfbenchmarks.com, research and insights, and grab the report right there. It's going to be the first item on the agenda. And then, of course, cfbenchmarks.com is where the rest of our amazing content is. As well, if you like podcasts, you love this podcast, Spotify and all the other platforms are your friends. Once you've done that, we'll see you again for the next new episode of CFB Talks Digital Assets. Thanks for joining us.
Thank you for listening to CFB Talks Digital Assets. This recording is for informational purposes only and should not be considered investment advice. This recording is not intended to persuade or incite you to buy or sell any financial products noted within, including but not limited to exchange-traded funds, mutual funds, equities, other instruments that reference any index provided by CF Benchmarks Limited, or crypto assets. Any commentary, interviews, and discussions are opinions only and should not be considered a personalized recommendation. Please contact your financial advisor or professional before making an investment decision. Note, some of the underlying instruments cited within this recording may be restricted to certain customer categories in certain jurisdictions.